It's clearly worrisome. There's never been a bankruptcy of the U.S. or a country like it, so we don't know what's going to happen. Right now, the U.S. dollar is what's called the reserve currency of the world, and we get to print them. And we can print, in the short run, we can print as many as we want. And as long as that's the case, we're not going to go under. It's like if you have an unlimited checking account, you can pay your credit card bills without limitation. We just don't know where it's going. That's the problem.
When major market analysts, billionaire investors, and fund managers start to worry about the market's future, it means something disastrous is coming. Now, a major shakeup is on the horizon, and Howard Marks, a billionaire investor and analyst, is pointing to a significant shift. For those unfamiliar with him, Marks is a genius who amassed substantial wealth during corporate chaos, thanks to his unique investment approach focused on acquiring distressed debts. In 1995, Marks co-founded Oaktree Capital Management, an asset management firm that mirrored his investment philosophy. Starting with a modest $7 billion in assets, the firm has transformed into a financial giant, now commanding a staggering $180 billion. Marks, known as the distressed loan tycoon, is lauded for more than just financial ingenuity. He writes memos acting as crystal balls, providing profound insights into the market's future. That's when he gives the concept of sea change within his memos, an element both fascinating and unsettling for investors. Now, in his latest interview, Marks warns of a third sea change, an upcoming financial transformation set to reshape the global financial order forever. Even the U.S. would not be protected from it because it will be the very center of this crisis. The crisis can strip the U.S. of the leverage that once secured its status as the world's top economy. When Marks says something like that, you have to take it seriously. So, what exactly did Howard Marks reveal? Well, he talked about a once-in-a-lifetime financial event that will change everything. Let's know the crux of his recent interview in this video. Chapter 1. The Bygone Golden Era.
It's about fair. What I would say is that remember in 1980, the Fed funds rate was 20, and I had a loan outstanding from a bank at 22.25. 40 years later, the Fed funds rate was 0, and I had a loan outstanding from a bank at 2.25. So the decline of interest rates by 20 percentage points over that period was a dominant factor in the financial world. I think it was the most important single event in the financial world in the last 50 years. Doesn't get the credit.
Well, okay, was that the first sea change in your investment career?
This is that was really the second. But the third follows on from that. In the period 09 through 13, the Fed took the Fed funds rate to 0 to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment, which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment.
Howard Marks argues that households, banks, and businesses in the United States have so far enjoyed the benefits of historically low interest rates and easy access to loans. This favorable environment allowed them to make purchases and delay payments thanks to accommodating interest rates and the dominant buy now, pay later policy. It was because of the United States' ability to effortlessly create money, leading to an inflated environment that will now have a spillover effect beyond its borders. Let's understand how. The surplus dollars, freshly printed, consistently flowed into the global market in return for imported goods and services, maintaining a delicate balance. Essentially, the U.S. could acquire products from any part of the world and settle transactions in dollars stored in the central banks of those nations. However, Howard Marks now indicates a shift in this system, where the U.S. utilized its position as the predominant financial power. According to him, this transformation marks the onset of the third sea change, bringing inevitable and disturbing changes to the United States. Chapter 2. End of easy money.
The main point of sea change is we're no longer in an easy money environment.
So you mean all the geniuses of private equity are not geniuses? We've been benefited from low interest rates?
Well, you know, there is a part in sea change where I talk about the fact that a guy says, oh, we can buy this company and make 10% a year. And then he turns to his capital markets person and says, what do it cost to get the money? We can borrow at 8. Borrow at 8, invest at 10, great, we do it. You buy the company, but in the stimulated environment of low interest rates, the company does better, you make more than 10. Your cost of money declines from 8 to 6 to 5, and it costs you less to borrow the money, and you say, boy, I'm a genius.
All right, so let me make sure I understand. Your view is the interest rates have come up and are fairly high right now, but the conventional wisdom in Washington, which is not always right, in fact it's wrong more than it's right, is that the Fed probably next year will begin to lower interest rates. And if the Fed does begin to lower interest rates because inflation's getting down to 2%, their target, you don't think interest rates will come down and we'll go back through another 20 years of low interest rates? Why do you think that we're going to keep interest rates relatively high?
I think that what I said in the memo is that rates are likely to be between 2 and 4, not between 0 and 2, the Fed funds rate. And, you know, between 0 and 2 is an emergency measure. And, you know, rates were, the Fed funds rate was 0 much of probably the majority of the time in the 09 to 21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years.
Marx explains some unsettling events that for many are predictions. However, he doesn't see these as mere predictions. Rather, he considers them carefully calculated possibilities destined to materialize. He argues that the U.S. has previously experienced an era of extremely low interest rates and abundant liquidity, creating favorable financial conditions for businesses and investors to prosper. According to him, this period is the era of easy money. This era fueled the U.S. economy, enabling Americans to improve their living standards without financial worries. The dominant buy now, pay later policy allowed Americans to afford everything by relying on debt. Interestingly, this isn't just a nostalgic reflection of the past, but a current reality, where most Americans use credit cards for daily expenditures. According to reports, in the second quarter of 2023 alone, U.S. credit card debt surpassed $1 trillion, marking an increase of $45 billion in just 3 months. However, Marx warns that this environment is approaching its end. It's because the era became the very reason for its downfall. It annihilated itself. It led to asset price inflation, creating a highly stressful period in the investment market. It's essential to understand this point because, as mentioned earlier, the U.S. exported this inflation. The extra money it was printing was being exported in return for consumable products and goods. However, not all of this money was exported. Some was invested in various assets, increasing their demand and therefore their prices. This inflation couldn't be exported. Now, Marx argues that this asset price inflation raises concerns about potential market bubbles. Simultaneously, the low interest rate environment has boosted borrowing, resulting in high debt levels across various sectors. Reports reveal that recently, U.S. household debt surpassed $17 trillion. In response to this, Marx predicts a sea change, meaning higher interest rates, which are currently evident in the U.S. This shift will not only make future borrowing expensive, but will also increase rates on existing loans, leading to a time when companies may default on their debts with no one to bankroll them. This period would make investing in distressed debts a financial suicide, because no bank and, in turn, the government will offer easy money. Chapter 3. Businesses and Real Estate Doomed.
This period of 09 through 21, easy period, easy to get money. So most bankruptcies don't occur because you have a business and it loses money, goes away. It occurs because a business borrows money, times get tough, and when it goes to refinance that loan, nobody ever repays their debts. They just refinance it. And when they go to the bank to refinance it, the bank says, you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher. So it really comes from most bankruptcies or defaults are associated with a maturity which is unmet. And I think that when you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
So is it your expectation that over the next 2 or 3 years you'll see more defaults in buyouts or real estate? It's often thought that commercial real estate in big cities is going to have a lot of defaults in the debt.
Yes, well, I think it was the long-term average default rate on high yield bonds, for example, is close to 4% for the last, I guess I've been in them 45 years. We didn't have any years in the last 15 at 4%. It was a very low period. In the coming years, there will be some. The way I sum it up in further thoughts, I say, you found a company to buy, you went to the bank, they said, we'll lend you $800 million at 5%. Now the loan is up for renewal, you go in, they say, fine, we'll lend you $500 million at 8%. So you have less money and your cost of capital is higher, and you have a $300 million hole that you can't fill.
According to Howard Marks, businesses would bear the brunt of the impact even if households manage to pay their loans during rising interest rates. Since businesses borrow from millions to billions of dollars, even a slight increase in interest rates can have disastrous consequences, potentially leading to bankruptcy. You should know that in the past, businesses avoided bankruptcy or recovered after going bankrupt by securing loans. However, Marks suggests that they will not be as fortunate this time. Silicon Valley Bank and Signature Bank manifest this, and they have already experienced a collapse, partly attributed to high interest rates. We have to compare that with what happened just before the 2008 financial crisis. Interestingly, the rise in interest rates played a crucial role in triggering the 2008 financial crisis. During the housing bubble, many homeowners and businesses took advantage of low interest rates to accumulate debts. However, as interest rates began to climb, numerous individuals and businesses faced challenges paying their mortgages, resulting in foreclosures and widespread financial crises, ultimately leading to a market crash. Now, with the anticipated rise in interest rates, Marks argues that more companies will default on their loans. This will not only create a substantial void in the economy due to their collapse, but also lead to the disappearance of non-performing loans, ushering in a level of turmoil unprecedented in our experience. In other words, no one will pay back their loans as more loans won't be offered to them to handle their previous loans. Chapter 4. Government's Dilemma and Dollars Fall.
There's never been a bankruptcy of the U.S. or a country like it, so we don't know what's going to happen. Right now, the U.S. dollar is what's called the reserve currency of the world, and we get to print them. And we can print, in the short run, we can print as many as we want. And as long as that's the case, we're not going to go under. It's like if you have an unlimited checking account, you can pay your credit card bills without limitation. We just don't know where it's going. That's the problem. People, this business about using a default as a negotiating tool is very, very dangerous.
That's when things get serious. Marks reveals a disturbing insight. The government itself won't escape the impact of the sea change. He argues that the government is forced to issue new debt, inevitably leading to increased money printing. This will create inflation, forcing the government to increase interest rates further, which in turn will cause more bankruptcies. This will be a perpetual cycle nobody can avoid. Additionally, he argues that the government must refinance its debts at elevated interest rates, resulting in budget deficits. A historical example of this scenario is visible in the 1980s when the United States grappled with surging interest rates. The government had to refinance its debt at higher rates, leading to expanded budget deficits and increased government debt levels. However, the challenges don't end there. Marks argues that dollar devaluation poses an additional hurdle for the government. With increased money printing, the dollar's value is expected to decline sharply. Consequently, this will increase the value of U.S. national debt, prompting Congress to once again grapple with a debate on the debt ceiling. Simply put, the upcoming financial event will have no rescuers. Bankrupting companies will face bankruptcy, and banks will refrain from offering loans because central banks have increased interest rates. This places governments in a crisis as their debts increase, with limited available revenue to finance them. Do you think Howard Marks is right? Will a financial crisis be inevitable, and this time there will be no protectors to bankroll collapsing companies? Let us know your thoughts in the comments section right below. Also, subscribe to our channel if you would like to watch more videos like this, giving you important financial updates that matter. Thanks for watching.